Most Australians assume their family trust is protecting them. But right now, the ATO is quietly targeting thousands of trust structures. And if you're planning to retire on the age pension, what you don't know could cost you everything. I'm going to walk you through exactly what's happening, why your family trust might be working against you, and what you need to do before it's too late. Stay with me, because this information could literally be the difference between a comfortable retirement and financial disaster. Let's start with the basics, because I know some of you are watching this thinking, wait, I thought a family trust was one of the best ways to protect my assets. And look, for a long time, that was partially true. Family trusts have been used by Australian families for decades to distribute income, minimize tax, and protect wealth across generations. But here's the thing. The rules have changed, the ATO has changed, and how Centrelink assesses your assets has always been far more aggressive than most financial advisors tell you up front. So what exactly is the ATO alert we're talking about? The Australian Taxation Office has been ramping up scrutiny on discretionary trusts. That's the technical name for most family trusts. For several years now. They're looking at how income is distributed, who the real beneficiaries are, and whether trusts are being used to hide assets or shift income in ways that don't reflect economic reality. But here's where it gets really dangerous for retirees and pre-retirees. It's not just the ATO you need to worry about. It's Centrelink. Because when you apply for the age pension, Centrelink has its own set of rules about trusts. And those rules are brutal. Let me paint you a picture. Imagine a couple in their late 60s. They've worked hard their whole life. They have a family trust that holds their investment property and some shares. On paper, they've distributed income to adult children for years, kept their own taxable income low, and they genuinely believe their assessable assets are modest. They apply for the age pension expecting at least a part pension. And then the letter comes. Centrelink has assessed the full value of the trust assets as belonging to them, the trust's appointed persons, and they don't qualify for a single cent. This is happening to real Australian families right now. Here's why. Centrelink uses something called the attributable stakeholder rules under the Social Security Act. These rules say that if you or your partner have the ability to control a trust, meaning you're the appointor, the trustee, or you have the power to direct how assets and income are distributed, then the entire value of that trust's assets can be counted as yours for pension assessment purposes. It doesn't matter that the trust is a separate legal entity. It doesn't matter that you've been distributing income to your kids. If you have control, Centrelink can attribute the whole lot back to you. And this is where so many people get blindsided. They set up their trust years ago with the best intentions. They followed the advice they were given at the time. But nobody sat them down and said, by the way, when you're 67 and trying to access the pension, this structure that saved you tax in your 40s could completely disqualify you in your retirement. Now let's talk about the ATO side of this, because the two risks, ATO scrutiny and Centrelink assessment, are actually connected in a really important way. When the ATO issues guidance or conducts reviews on trust distributions, they're effectively shining a spotlight on these structures. And that spotlight doesn't just stay with the ATO. Information sharing between government agencies in Australia has increased significantly. When your trust is flagged for review by the ATO, it can trigger a closer look by Centrelink too. So an ATO asset alert isn't just a tax problem. It can become a pension problem very quickly. The ATO has been particularly focused on what they call trust stripping arrangements and situations where the economic benefit of a trust's assets doesn't match who's formally listed as beneficiaries. They've also been cracking down on cases where a trust loans money to a trustee or related party without proper commercial terms. These are called Division 7A issues for those with company trustees, and where income is distributed to low-income beneficiaries purely to minimize tax rather than for any genuine purpose. If your trust has done any of these things, you're on the radar. And when you're on the radar with the ATO, you should assume Centrelink is eventually going to take a much harder look at your situation too. So, what does this mean in practical terms for your pension eligibility? Let's run through the key scenarios. If you are the appointor of your family trust, which most people who set up their own trust are, Centrelink will typically assess all assets held in that trust as belonging to you. Full stop. The current full-age pension for a couple is roughly over $40,000 per year combined. To qualify for even a part pension, your assessable assets need to fall under certain thresholds. For a homeowning couple, you lose the pension entirely once assessable assets exceed around $1 million. If your trust holds a couple of investment properties and a share portfolio, you may already be well over that threshold without even realizing it. If you are the trustee of your trust, and you also happen to be a beneficiary, the same attribution rules apply. Centrelink isn't interested in the legal technicalities. They're interested in who can access and control the money. If that's you, it's your asset. Now here's the critical question everyone asks at this point. Can I just resign as appointor or trustee before I apply for the pension? And look, I understand why people ask this. On the surface, it seems logical. But I need to be very direct with you here. Attempting to restructure your trust solely to become eligible for government payments is something Centrelink has specific rules about called deprivation provisions. If you dispose of an asset or relinquish control of an asset within 5 years of claiming, Centrelink can still treat it as yours. And in some cases, they can look back even further. Trying to game the system at the last minute doesn't just fail. It can result in penalties, debts, and being locked out of entitlements for extended periods. This is exactly why you need to be planning this at least 5 to 7 years before you intend to retire. Not 5 months. Not the year before. 5 to 7 years minimum. So what should you actually do? First, get an immediate review of your trust deed and your role within it. Understand exactly what powers you have and what Centrelink will see when they assess your situation. Don't assume your accountant has considered the pension angle. Many accountants are brilliant at tax, but aren't specialists in Centrelink means testing. You need someone who understands both. Second, look at whether the assets currently sitting inside your trust are actually best placed there given your retirement goals. There are circumstances where restructuring over time, well before the 5-year window, makes genuine sense. This isn't about hiding assets. This is about legitimate, long-term financial planning that takes into account your full picture. Third, understand the difference between what the ATO sees and what Centrelink sees. These are 2 separate assessments with 2 separate sets of rules. You might be completely compliant with the ATO and still be disqualified from the pension because of how Centrelink attributes trust control. Both conversations need to happen with your advisor. Fourth, document everything. If your trust has genuine commercial reasons for its structure, if distributions have been made for genuine purposes, if loans have been made on proper commercial terms, make sure you have the paperwork to back all of that up. Both the ATO and Centrelink have the power to request records, and in a review situation, documentation is the difference between a problem resolved and a problem that destroys your retirement plan. Finally, and I cannot stress this enough, do not rely on what you were told when you set up the trust. Trust law has evolved, ATO guidance has evolved, and Centrelink policy continues to be updated. What was good advice in 2005 or 2010 may be completely inadequate for your situation today. Book a review. Get current advice from someone qualified in both tax and Social Security law. Here's the bottom line. Family trusts are not inherently bad. They can absolutely still play a role in a smart retirement strategy, but they are not set and forget. They are not invisible to Centrelink. And right now, with the ATO actively issuing guidance and increasing scrutiny on trust structures, there has never been a more important time to make sure your trust is working for your retirement, not against it. If this video helped you understand something that your advisor never explained clearly, please share it with someone you know who has a family trust and is approaching retirement. It might be the most valuable thing you do for them this year. And if you want to go deeper on how Centrelink assesses specific asset types, I've got videos covering the pension assets test and income test in detail. Go watch those next. Your retirement is too important to leave to chance. Get the right advice, plan early, and make sure every structure you have is pointing in the same direction, toward a secure future.